All right, we are with Ken Courtis, talking about the potential growth that is likely to happen in the United States. At least that's perceived. But your concern or question seems to be around how do you fund it?
Well, the deficit is going to increase quite dramatically if you chop taxes and then you have this growth and the increased spending on infrastructure. So the issue is, how do you finance this? Because if the deficit keeps going up and up, it's going to drive interest rates up, which will smother the growth. So I think there's going to be a deal with Japan. Japan's economy is going nowhere. The only way they can stimulate that economy from here is to devalue the yen. So the Bank of Japan has announced that they're going to keep 10-year bonds at 0%. US bonds yields are rising. That's going to force money out of the yen into the US. So the yen will get very weak. 125 to the US dollar, 135, 140 to the US dollar. But I think that's the type of deal that we see coming.
What does that mean then for investing? It sounds like you can continue, at least for the near term, not even short term, but near term, go long the US dollar.
Structurally, stay long the US dollar, stay long the US dollar, stay long the US dollar. I see the euro going below parity. I see it going close to 0.9 to the US dollar. It's 1.04 today. The yen, as I just said, 125, 135, 140 against the US dollar. As you know, I think the Canadian dollar will also get weaker as we go through this transition. That's on the currency market.
Okay.
For the stock market, I see you want to stay long financial sector in the US. You want to stay long those sectors that are going to gain immensely from this boom that he's going to create in the US economy.
Ken, we talk a lot about where we are today, the Dow nearing 20,000. You, of course, have been in the business for a long time, and maybe this is just a number, but it seems to be reflective of people's views now towards the equity market. What do you do in this type of environment?
Well, there's a change in leadership that's happened. During the Obama boom, and we've had a huge boom during Obama. The market's up 150% since the bottom. It's been driven by stocks that are very different than the ones that are going to drive now.
Okay.
Banks, they were on their back for the last 7 or 8 years. Pharmaceutical sector on its back for the last 7. Materials on the back. But with this big infrastructure investment and faster growth in the economy and cutting back regulation, those sectors are going to do well. Energy is going to do well.
Okay.
I see energy prices higher, and they're going to chop back on regulation. You go down to the coal country in Appalachia, everywhere you see signs. Trump digs coal. And he's put Exxon in his cabinet. So energy, finance, cyclical materials, those sectors will do very well.
Ken, when you take a look at the Canadian market, the TSX, you are optimistic about Canada, but at the same time, too, you also say that we're going to have a weaker Canadian dollar. Where, if at all, do you want to be invested in the TSX?
The energy sector looks cheap still in Canada, so I would be there. A lot of people think that the run-up in material prices, iron ore, copper, that's just a pop. I don't believe that. I think we've got legs under this rally, and it will be sustained for a while. Met coal is up dramatically, and I think it will not stay at these levels, but it will stay strong over the year ahead. So there are sectors that no one wants to invest in coal.
Right.
That's a good time to buy.
With respect to the fixed income market and this unexpected rise in the interest rate environment, what do you do? Is the bull market over for bonds?
The 35-year bull market is dead.
Dead.
We have now entered into a period which is driven by fiscal policy, deregulation, rather than a period driven by monetary policy that we've had basically the last 10, 15 years.
So for people who say, well, I want the security or the perceived security of owning fixed income, you say what to them?
You better believe that you're going to have to own it until maturity, because it's going to be very volatile in the meantime.
Okay. Ken, I would be remiss if I didn't ask you about some of the geopolitical issues.
What's going on in Germany in the run-up to the election next fall could lead us to see the current government defeated, and a government that's made up of the Greens, the Social Democrats, and the left. So what they call a red-green coalition.
Okay.
I think that'll really frighten people in Europe. You've got the French elections coming up, you've got the Italian elections coming up, you've got the Dutch elections coming up. I think Europe is going to be under a lot of pressure politically, and that's one of the reasons I see the euro going below 1 to the dollar.
Okay, and it sounds as though as well you're much more, as it relates to equities, U.S.-centric?
I like the U.S. I'm not one of those who think that China's over. Quite the contrary. I think we'll look back in 10 years and say that this was a transition in the Chinese economy leading to a much stronger, more interesting China.
What's the best way to go long China?
The best way to go long China, I think, is play some of the export plays into China, or buy these ETFs that focus on China. Because I think if you try to, unless you're a real expert, buying one Chinese stock or another one is probably pretty complicated.
Okay, Ken, always great to be with you. Thank you very much.
Thank you.
Thank you. We really appreciate it here at BNN. Thank you so much.